If you turn 65 this year, the federal government is currently sitting on roughly $6,000 per person that it will hand back to you only if you know which box to check. And if you don't check it, that money just quietly disappears into the general fund, like you never earned the right to it at all. Nobody at the IRS is going to call you about this. Nobody at your bank is going to mention it either. And quick heads up, this is general info to help you look in the right place, not personal tax advice. Now let's get into exactly what changed, because this one is brand new for 2025, and most retirees still have no idea it exists. Here's the scenario I want you to picture. You're 68 years old. You worked for decades. You paid into the system every single year without missing a paycheck. And now you sit down every April, hand your paperwork to whoever does your taxes, and just trust that the number they hand back to you is the number you're supposed to get. Most of the time, that trust is misplaced. Not because anyone is cheating you on purpose, but because the tax code changed in a big way in the middle of 2025, and a lot of preparers, especially the software you might be using at home, haven't fully caught up on how to apply it to someone exactly in your situation. The result is real money left on the table, not hundreds of dollars, in many cases thousands. And it isn't just the IRS. Your county has property tax relief sitting on a shelf with your name on it, if you'd only fill out the form. Your bank has a fee waiver it will never mention unless you ask for it by name. And Medicare has a premium surcharge that catches people completely off guard the year after they retire, simply because nobody told them the rule in time to do anything about it. Everything I'm about to walk you through comes straight from primary sources. The new senior deduction I'm about to explain is written into what's officially called the One Big Beautiful Bill Act, signed into law in July of 2025. And it shows up on your return on a form called Schedule 1A. The required minimum distribution rules come from the Secure 2.0 Act, passed by Congress in December of 2022. The Medicare premium rule comes straight from the Social Security Administration's own guidance on what's called IRMAA. None of this is a rumor. None of this is a loophole that might get closed next year. This is current law, sitting in the IRS's own publications, waiting for you to claim it. Let's start with the biggest one, because it's brand new, and it's the one almost nobody has heard of yet. Beginning with your 2025 tax return, the one you'll file in early 2026, there is a new deduction just for people 65 and older, worth up to $6,000 per person. If you're married and both of you are 65 or older, that's $12,000 off your taxable income. And here's the part that surprises people. You get this whether you take the standard deduction or you itemize. It doesn't replace anything you were already getting. It stacks right on top. Picture a married couple, both 70 years old, filing jointly. Before this new deduction even enters the picture, their standard deduction for 2025 is $31,500, plus an extra $1,600 per spouse just for being 65 or older, which is another $3,200. Add the new $6,000 per person bonus on top of that, and this couple can shield more than $46,700 of income from federal tax before a single dollar gets taxed. For a single filer who's 65 or older, the base standard deduction is $15,750, plus $2,000 for age, plus the new $6,000 bonus, for a total of $23,750 shielded from tax. Now here's what most retirees do wrong. This deduction phases out as your income rises. It starts shrinking once your modified adjusted gross income crosses $75,000 for a single filer, or $150,000 for a married couple filing jointly, and it disappears completely at $175,000 single or $250,000 joint. Most middle-income retirees living on Social Security plus a modest pension or IRA withdrawal fall well under that threshold and qualify for the full amount. But because this deduction is so new, a lot of people either don't know to ask for it, or their tax software from last year hasn't been updated to walk them through the new form. If your preparer or your software doesn't specifically mention Schedule 1A this year, that's your sign to ask about it directly. Now here's where it gets important, because this next one has been sitting in the tax code for decades, and people still miss it constantly. On top of the new bonus deduction, there's the older, separate additional standard deduction, just for being 65 or older, and I want to make sure you understand this is a completely different line item from the one I just described. They stack together. This is the $1,600 per spouse for married couples, or $2,000 for a single filer that I mentioned a moment ago. You claim it simply by checking a box on your Form 1040 that says you or your spouse were born before January 2nd of the relevant birth year cutoff. That's it. No income limit, no phase out, no complicated math. And yet every tax season, preparers report seeing returns where the taxpayer clearly qualifies and the box sits unchecked, because the software defaults to unchecked and nobody thought to look. Most people stop here, but don't, because there's a third deduction hiding in your medical expenses that almost nobody actually calculates correctly. The IRS lets you deduct medical expenses that exceed 7.5% of your adjusted gross income, and adjusted gross income is your income number before any standard deduction gets subtracted. Here's a concrete example. Say your adjusted gross income for the year is $48,000. 7.5% of that is $3,600. That means the first $3,600 of medical spending doesn't count, but every dollar above that line does. For a lot of retirees on Medicare, that threshold gets crossed faster than you'd expect once you add up your Part B premium, your Part D premium, a supplemental Medigap policy, dental work, hearing aids, eyeglasses, and prescription copays across a full year. If your total medical spending for the year came to $7,600, you'd be able to deduct $4,000 of it, but only if you itemize instead of taking the standard deduction, and only if you actually tracked your receipts. Most retirees never do this math because they assume itemizing isn't worth it anymore, since the standard deduction got so much bigger. Sometimes that's true, but if you had a major dental procedure, a hospital stay, or a hearing aid purchase this year, hearing aids alone can run $2,000 to $7,000 a pair. It's worth actually running the numbers both ways before you file, because 1 year of high medical costs can flip the math in your favor. Here's the part they never tell you about required minimum distributions, and this affects almost everyone with a traditional IRA or an old 401k. Congress has pushed back the age at which you're forced to start withdrawing from these accounts twice in the last few years. It used to be 70 and a half, then it moved to 72. Under the Secure 2.0 Act, if you were born in 1951 through 1959, your required minimum distribution age is now 73. If you were born in 1960 or later, it jumps again to 75. That means depending on your birth year, you could have anywhere from 1 to several extra years where your traditional IRA or 401k just sits there, growing, completely untouched by any forced withdrawal. This matters because every dollar you're forced to pull out gets taxed as ordinary income the year you take it, and it can also push up your Medicare premium, which I'll get to in a moment. The mistake I see constantly is retirees who assume they still have to start withdrawing at 70 and a half, because that's the number they remember from years ago, and they start pulling money out earlier than the law actually requires, paying tax years before they had to. And connected to that is a tool almost nobody uses, even though it can eliminate the tax bite from your RMD entirely. It's called a qualified charitable distribution. If you're 70 and a half or older, you can transfer money directly from your IRA to a qualified charity, as much as $108,000 in a recent tax year, and that amount counts towards satisfying your required minimum distribution without ever showing up as taxable income on your return. Compare that to writing a check to the same charity out of your regular bank account after taking your RMD as cash. In that version, the full RMD hits your taxable income first, and then you take a charitable deduction separately, which only helps if you itemize. With a qualified charitable distribution, the money never counts as income at all. Picture a retiree with a $15,000 required minimum distribution who already gives $5,000 a year to their church. If they take the full RMD as cash and write a separate check to the church, all $15,000 shows up as taxable income, and the $5,000 gift only helps their tax bill if they're itemizing that year. If instead they route $5,000 of that RMD directly from the IRA custodian to the church as a qualified charitable distribution, that $5,000 never touches their taxable income at all. Only the remaining $10,000 counts as income. Same generosity, same amount given, meaningfully smaller tax bill. The catch is, it has to be a direct transfer from the IRA custodian to the charity. If the check comes to you first and you forward it, it doesn't count. You call your IRA custodian, tell them you want to set up a qualified charitable distribution, and they handle the paperwork on their end. Now here's a danger that has nothing to do with the IRS directly, and it blindsides more retirees than almost anything else on this list. The year after you retire, your Medicare premium can suddenly jump for a reason that has nothing to do with your current income. It's called the Income-Related Monthly Adjustment Amount, or IRMAA for short. And here's the mechanism. Medicare looks at your tax return from 2 years ago to decide what you pay for Part B and Part D this year. So your 2026 premium is based on your 2024 income. If 2024 was your last full year of working with a full salary, your income that year might look a lot higher than your actual retirement income looks today. And Medicare doesn't know that unless you tell them. For 2026, the surcharge kicks in once your income crossed $109,000 as a single filer or $218,000 filing jointly back in that look-back year. And the standard Part B premium of $202.90 a month can jump as high as $689.90 for the highest earners. Here's what most people don't know. There's a specific form, SSA 44, that lets you tell Social Security about what's called a life-changing event. Retirement itself counts as one, and ask them to use your current, lower income instead of the 2-year-old number. A lot of retirees pay the inflated premium for a full year or more simply because nobody told them this form existed. If you retired recently and your Medicare premium jumped, this is worth a phone call to the Social Security Administration this week. Let's shift away from the IRS for a moment, because the next drain on your money isn't federal at all. It's sitting in your checking account statement in print so small you'd need a magnifying glass to notice it. Most of the big national banks charge a monthly maintenance fee on regular checking accounts, typically somewhere between $10 and $15 a month, which adds up to $120 to $180 a year for the simple privilege of keeping your money there. Nearly every one of those same banks has a senior waiver buried in its account terms. Some waive the fee automatically once you turn 65. Others waive it if you have your Social Security or pension direct deposited into the account. A few will waive it the moment you simply ask a teller. None of them are going to volunteer this information, because to the bank, your unclaimed $12 or $15 a month is quiet, easy revenue. Think about what that actually adds up to over time. At $15 a month, that's $180 a year. And if you've been paying it without asking for the waiver for the last 5 years, that's $900 that quietly left your account for absolutely nothing in return. The fix here takes about 15 minutes. Walk into your branch, bring something that shows your date of birth, and ask specifically, do you have a senior checking account or a fee waiver for account holders 65 and older? Don't ask if there's a fee. Ask about the waiver by name, because tellers are trained to answer the question you actually ask, not the general question you might be tempted to lead with. Here's the part they never tell you at the county courthouse either. Most states offer some form of property tax relief once you turn 65, and almost none of it is automatic. You have to file a form to get it. The details vary a lot by state, so let me give you a sense of the range. Some states knock a flat amount, often somewhere in the range of $25,000 to $75,000, off the assessed value of your home before your tax bill is calculated. Some states freeze your home's taxable value the year you turn 65, so even if the market value keeps climbing, your tax bill doesn't. A handful of states let you defer the entire bill as a lien against the home until it's sold, and a few actually mail you a rebate check. Picture a home assessed at $300,000 in a state that offers a $50,000 senior exemption. That exemption doesn't just save you a few dollars. Depending on the local tax rate, it can knock several $100s off that single year's bill. And it applies again every single year going forward, not just once. Over a decade in that home, an exemption like that can easily add up to 5 figures in savings you'd otherwise have handed over without a second thought. Every one of these programs requires an application, usually with a deadline early in the calendar year, and proof of your age and that the home is your primary residence. Your county doesn't have the staff to call every senior homeowner and point this out, so the full bill just keeps arriving every year until you file the paperwork. The fastest way to find your state's specific program is to search your state's name along with the words Senior Property Tax Exemption. which will almost always take you straight to the official state or county assessor's page. If nothing comes up, call your county assessor's office directly and ask 2 questions. Do you have a senior exemption? And what is the deadline to apply this year? There's one more piece worth knowing about, and it's easy to overlook because it doesn't show up as a deduction on your return at all. It shows up as a credit, which is actually more valuable, because a credit reduces your tax bill dollar for dollar instead of just reducing your taxable income. It's called the credit for the elderly or the disabled, claimed on Schedule R. It's designed for retirees 65 and older with fairly modest income, generally under about $17,500 for a single filer, or $25,000 for a married couple, depending on how much of that income is Social Security versus other sources. And the credit amount depends on your exact income and filing status. It's a smaller dollar amount than the deductions we've already covered, often a few $100s, which is probably why most tax software doesn't prompt you about it unless your income clearly falls in that lower range. If your total income is on the modest side, it's worth having your preparer specifically check whether you qualify for Schedule R, rather than assuming the software will catch it automatically. Now let's talk about something that trips up more retirees than almost anything on this list. And it's not a deduction you're missing. It's a threshold nobody adjusted in over 40 years. Up to 85% of your Social Security benefit can become taxable, but whether that happens depends on something called your combined income, which is your adjusted gross income plus any tax-exempt interest, plus half of your Social Security benefit for the year. Here's the part that should genuinely bother you. The thresholds that determine whether your Social Security gets taxed at all: $25,000 for a single filer, $32,000 for a married couple filing jointly, have not been adjusted for inflation since they were written into law back in 1983 and 1993. Every other number in the tax code creeps upward every year to keep pace with the cost of living. This one never has. That means a retiree today with a modest pension and a Social Security check that simply kept up with cost of living adjustments over the years can get pulled into taxation on their benefits, even though their real purchasing power hasn't grown at all. Most retirees don't run this calculation until tax time, and by then it's too late to do anything about the current year. If you're pulling money from a traditional IRA or taking a large capital gain in the same year, you're also drawing Social Security. That extra income can push a big chunk of your benefit into taxable territory that wouldn't have been taxed otherwise. The fix isn't complicated, but it does require planning ahead. Before you take a large IRA withdrawal or sell an investment with a big gain, it's worth running the combined income math first, or asking your preparer to run it for you, so you know in advance whether that withdrawal is going to drag part of your Social Security into the taxable column along with it. And here's one final item that's easy to miss if you move states at any point during retirement, or if you're thinking about it. Not every state taxes retirement income the same way, and the differences are bigger than most people realize. A number of states don't tax Social Security benefits at all, and a smaller but still meaningful group of states don't tax any retirement income whatsoever. No state income tax on your pension, your IRA withdrawals, or your Social Security. Other states tax all of it exactly like ordinary wages, no exceptions. If you're retired and living on a fixed income, the difference between a state that taxes your pension and IRA withdrawals and one that doesn't can be worth several $1,000s a year, every single year, for the rest of your retirement. This isn't a call to pack up and move. That's a much bigger decision than any tax video should try to talk you into. But if you're already considering relocating to be closer to family, or you're deciding between 2 states for a second home, it's worth spending 20 minutes looking up how each state treats retirement income specifically, because the sticker price cost of living in a place can hide a very different real cost once state taxes on your retirement income enter the picture. So here's your one action step for this week, and I want to make it as concrete as possible. Pull out last year's tax return, or this year's draft if you're working on it now, and look specifically for a form called Schedule 1A. If it isn't there and you're 65 or older, that's the new $6,000 senior deduction, and you need to ask your preparer directly why it's missing, or go back into your software and look for it by name. It may be sitting in a section you skipped past. That one form by itself is worth more to most retirees than everything else in this video combined. If this helped you see money you didn't know was sitting there, do me a favor and subscribe, because every week I go through one more rule like this one, plain English, straight from the source, no sales pitch attached. Next week I'm covering the handful of years right before your required minimum distributions kick in, and why so many financial planners call that narrow window the single best opportunity you'll ever get to convert money into a Roth IRA. I'll see you there.